The war playing out in the Middle East right now is not just a regional military conflict. What if it is actually the lit fuse sitting directly underneath the most fragile financial system the world has built in decades? Today, I'm going to walk you through something that most financial media is either too distracted or too cautious to say out loud. The Iran war is not just about oil. It is not just about the Middle East. It is a convergence event. And when you understand why, you will never look at your portfolio, your savings, or the global economy the same way again. Stay with me through this entire video because I am going to connect dots that most analysts keep deliberately separate. Energy markets, US debt, commercial real estate, the AI bubble, and global shipping lanes. These are not unrelated stories. They are fault lines. And right now, they are all being stressed at the exact same moment. Let me start with the geography because this is where everything begins. There is a narrow stretch of water between Iran and the Arabian Peninsula called the Strait of Hormuz. It is roughly 33 miles wide at its narrowest point. And through that 33-mile corridor in just the first half of 2025, approximately 20.9 million barrels of petroleum liquids passed every single day. That is roughly 20% of all global petroleum consumption. Not regional consumption, global, every day. On top of that, around 20% of the world's liquefied natural gas trade also flows through that same passage. So when we talk about Hormuz being a choke point, we are not being dramatic, we are being precise. This is the single most consequential maritime corridor on the planet, and it runs right through the center of the conflict we are watching unfold. Now here is where most people make their first analytical mistake. They hear oil spike and they think, okay, gas prices go up, consumers feel pain, eventually it settles down. That is not the full picture, not even close. The first wave of a Hormuz disruption is energy inflation, yes. We saw Brent crude briefly push toward $120 a barrel before pulling back during the height of the conflict. That kind of price movement is not just a number on a screen. It immediately reprices inflation expectations, which then reprices interest rate expectations, which then reprices growth assumptions. Three massive financial variables get destabilized simultaneously from one choke point. But then comes the second wave, and this is the one that most casual observers miss entirely. When markets have to start pricing and rerouting around the conflict, war risk insurance premiums longer, voyage durations, tighter vessel availability, fuel surcharges, and convoy risk, the inflation impulse stops being just about oil. It bleeds into manufacturing input costs, agricultural supply chains, consumer goods pricing, and trade finance. UNCTAD data from 2024 showed that prior shipping disruptions had already lifted global ton miles by 17% and kept freight costs elevated well beyond the initial shock. The system going into this is already less resilient than it was before the prior disruptions. You're hitting a bruise that is not fully healed. And here is something the IMF itself has put on record. Their managing director noted that a sustained 10% increase in energy prices could add roughly 40 basis points to global inflation, while shaving 0.1 to 0.2 percentage points off global growth. That combination has a specific name. It is called a stagflationary shock. And stagflation is the nightmare scenario for central banks because it means they cannot simply choose a side. They cannot cut rates to stimulate growth without making inflation worse. They cannot raise rates to fight inflation without deepening the economic slowdown. They are caught. And we will come back to exactly how dangerous that trap is in a moment. So that is Iran as a catalyst. But now I need to explain why this particular catalyst is so much more dangerous than it would have been 5, 10, or 20 years ago. Because the catalyst alone does not determine how bad things get. What determines how bad things get is the condition of the system the catalyst hits. And the condition of the system right now is something I want you to really absorb. As of March 6, 2026, total U.S. public debt stands at $38.87 trillion. The Congressional Budget Office projects the deficit for fiscal year 2026 alone will come in around $1.9 trillion. And on their current trajectory, debt held by the public is expected to climb to 120% of GDP by 2036. These are not alarmist projections from fringe analysts. This is the government's own scoring office running the numbers. The fiscal balance sheet is already deeply committed before any new crisis arrives. There's no clean slate here. Now layer on top of that what the Federal Reserve looks like right now. Their policy rate target range sits between 3.5 and 3.75% as of January 2026. Their total assets are still around $6.63 trillion. So we are in this strange middle ground where policy is not exactly tight in any pure historical sense, but it is also not free to move with the kind of confidence and aggression you would need to absorb a major shock. The balance sheet legacy of years of prior intervention is still sitting there. It has not been fully normalized, and inflation can be reignited at any moment by an energy shock. This is what I call the sequencing problem. In a normal downturn, you would expect the Fed to cut rates and the government to spend. But in a stagflationary environment caused by a geopolitical energy shock, cutting rates risks pouring fuel on already rising inflation. Not cutting rates risks letting a growth slowdown turn into something worse. There is no clean move. And market accidents happen exactly in this kind of environment, when the policy toolkit that investors have come to rely on for 15 years suddenly looks like it cannot be deployed the way everyone assumed. Now let us talk about the bond market, because this is where things get structurally dangerous in a way most people have not fully internalized. For decades, U.S. Treasury bonds were the world's risk-free asset, the benchmark, the collateral for the global financial system, the thing you run toward when everything else is falling. But when debt stocks are this large, and when inflation can be reignited by external shocks, Treasuries face two conflicting pressures at the same time. On one hand, fear drives people into them as a safe haven. On the other hand, rising inflation expectations and fiscal concerns push yields and term premium higher, especially on longer duration bonds. You end up with a split response instead of a unified one, and split responses create instability. Here is why that matters beyond just yields. The Treasury market is not just an investment market. It is the backbone of global collateral. Trillions of dollars in derivatives, repo agreements, international reserves, and funding structures are priced hedged and collateralized against Treasuries. If confidence in that market becomes impaired even temporarily, the entire global collateral stack becomes less stable. It is not just about higher yields. It is about whether the most fundamental benchmark asset in the world can still play its role. And right now, the combination of $38 trillion in debt and a reinflationary geopolitical shock is putting that function under stress in a way it has not been in modern financial history. Let me add another layer, because we are building a picture here, and each layer matters. Commercial real estate, specifically the office market. The Mortgage Bankers Association data shows that roughly $875 billion of the approximately $5 trillion in outstanding commercial mortgages is scheduled to mature in 2026. That is about 17% of the entire market coming due in a single year. And office is the most stressed sector within that. Vacancy rates remain near record highs. TREP data showed office CMBS delinquency hitting an all-time record of 12.34% in January 2026. Not a cyclical high, an all-time high. This is no longer a liquidity problem. For the weakest properties, this is a solvency problem. Hybrid work has structurally impaired cash flows for large swaths of office inventory. Refinancing at dramatically higher rates versus the loans that are maturing crushes debt service coverage ratios on properties that were already struggling to fill desks. And the reason this matters systemically is not just the real estate itself. It is where these loans and structures live. They sit on regional bank balance sheets. They are embedded in CMBS securities. They are held in private credit funds. They are part of pension fund allocations. And critically, commercial real estate property taxes are a major funding source for local governments. So a CRE stress event does not stay in the real estate sector. It radiates outward into credit markets, banking system stability, and local fiscal capacity simultaneously. Now here is the fourth layer that many financial commentators have been reluctant to discuss honestly: the AI boom. I am not here to claim artificial intelligence is fake or irrelevant. The technology is real, and its economic transformation may also be real. But at the market level, we have created an extraordinary concentration of capital, narrative, and valuation inside a single thematic story. That concentration introduces a particular kind of fragility. When capital, expectations, and market leadership become tied to one narrative, the stability of the broader system begins to depend heavily on that narrative continuing uninterrupted. Bloomberg has reported that AI demand is creating a historic shortage in memory chips. IDC projects that DRAM supply will grow around 16% in 2026. NAND supply growth is expected to reach about 17%. Both numbers remain below historical norms when compared with the pace of demand driven by the AI infrastructure build-out. In the short run, those supply constraints actually reinforce the boom. Scarcity pushes prices higher, strengthens margins, and keeps investor enthusiasm focused on the companies supplying the technology stack. But the system-level paradox is important. The same concentration that produces clear winners also makes the broader market increasingly sensitive to anything that weakens the AI narrative. A repricing in liquidity conditions could do it. A funding shock caused by higher interest rates could do it. A growth disappointment or policy shift could also change the tone very quickly. If that happens, the most crowded trade in the market could flip. What currently acts as a structural pillar of support could rapidly become the largest source of drawdown pressure. Markets behave very differently when everyone is positioned the same way. When conditions deteriorate and the water becomes rough, everyone tries to exit the same boat at the same time. Now step back and look at the broader picture. Each of the risks we discussed individually can easily be rationalized away by investors and policymakers. A regional war, many people argue, will probably remain contained. High government debt, they say, is manageable because the United States has always rolled its obligations successfully. Commercial real estate stress is often described as manageable in aggregate. AI concentration is defended by pointing to strong growth and the belief that the technological shift is still in its early phase. And to be fair, any one of those arguments might be correct if examined in isolation. Markets frequently absorb single shocks without creating systemic consequences. The real danger does not come from the individual factors themselves. The danger emerges when multiple stresses begin interacting and reinforcing each other at the same time. Consider the chain reaction. Rising tensions with Iran push energy and shipping costs higher across global markets and supply chains. Higher energy and shipping costs feed directly into broader inflation pressures. Transportation and fuel costs eventually pass through into consumer prices and industrial production costs. If inflation remains sticky or begins rising again, the Federal Reserve's ability to cut interest rates becomes severely limited. Monetary policy flexibility starts disappearing exactly when the economy may need it most. Limited monetary easing then worsens refinancing pressure throughout the credit system. Commercial real estate loans and corporate debt suddenly become more difficult and more expensive to roll over. Those refinancing pressures begin stressing regional banks and private credit portfolios. Balance sheets that were already fragile start facing additional strain. At the same time, weaker economic growth collides with extremely stretched valuations in the most crowded equity narratives, especially the technology segments tied to AI expectations. Meanwhile, the Treasury market must absorb all of these pressures. It does so in an environment where fiscal space is already heavily exhausted. Each link in that chain subtly weakens the next link. Stress compounds rather than dissipates as it moves through the financial architecture. Eventually, a tipping point appears. What originally looked like a manageable set of pressures becomes a nonlinear event with consequences far larger than the initial trigger. That is often how ordinary crises evolve into systemic ones. The visible shock is rarely the full story behind the breakdown. This is also why the next crisis may not resemble 2008 or even the pandemic shock of 2020. It may not arrive as a single dramatic collapse. Instead, it could unfold as a slow-motion chain reaction across sovereign bond markets, commercial credit rollover cycles, energy price transmission, and shipping disruptions. Crowded equity leadership could amplify the instability. When the same companies dominate both narratives and capital flows, volatility spreads rapidly once confidence begins to crack. The difficulty in containing such a scenario comes from the absence of a single pressure valve. Multiple systems feed stress into each other simultaneously. Historically, systemic events tend to follow this pattern. The trigger itself is often smaller than the imbalance it exposes. The combustible material already exists beneath the surface. The trigger merely synchronizes reactions that were already building across the system. Consider what that implies for the current environment. The combustible material is visible almost everywhere in the global financial structure. The United States carries roughly $39 trillion in federal debt. Office delinquencies in commercial real estate are near record levels. Equity markets display near record concentration around AI-related companies. At the same time, the central bank has limited room to maneuver either toward aggressive easing or tightening. Global shipping networks are still recovering from earlier disruptions and supply chain shocks. The Treasury market faces both persistent inflation pressure and enormous fiscal financing needs. At the center of these tensions sits a geopolitical conflict, threatening one of the most critical energy corridors in the world. That location alone magnifies the systemic sensitivity. Because of this fragile backdrop, a historically massive trigger is not required. Any meaningful additional shock could activate reactions across several interconnected systems. Before closing, it is important to clarify something. This analysis is not a prophecy about a guaranteed crisis. It is simply a risk assessment built from the data currently available. Multiple institutions are already documenting these vulnerabilities in their own projections and reports. The Congressional Budget Office outlines the fiscal trajectory. The IMF publishes detailed inflation calculations. Mortgage Bankers Association data highlights upcoming maturity walls in commercial real estate debt. TREP's delinquency reports show rising stress in office loans. None of these signals come from fringe sources or speculative commentary. The vulnerability is documented and the convergence is observable. The real uncertainty lies only in timing. Iran may or may not become the final synchronizing trigger, but its actions have already reignited energy inflation and destabilized a crucial shipping corridor. Those developments force a repricing of global risk across multiple markets simultaneously. They shrink the system's margin of safety and move several fragile structures closer to their breaking points. The essential takeaway is simple. Iran is not the entire crisis. It functions more like an accelerant added to an already unstable financial environment. The U.S. debt burden has consumed most fiscal flexibility. Inflation risks have consumed much of the remaining monetary flexibility available to central banks. Meanwhile, the bond market itself is beginning to shift from being a stabilizing force to a potential source of instability within the financial system. Commercial real estate remains a refinancing time bomb in weaker segments of the market. Those segments are embedded within the broader credit system and cannot be isolated easily. The AI boom has also increased market concentration and valuation dependence. That structure makes any future liquidity repricing far more dangerous than it would normally be. When energy shocks, debt stress, credit fragility, and valuation concentration converge simultaneously, the threshold for a global financial avalanche becomes dramatically lower. This is the core insight to keep in mind. The next trigger does not need to be historically large. It only needs to strike a historically fragile system at a moment when nearly all of the shock absorbers are already compressed. The practical question then becomes what investors and observers should actually do with this understanding. That discussion belongs to the next stage of the conversation. Recognizing systemic risk is only the first step. The second step involves positioning, protecting accumulated capital, and adapting strategies for a world where the traditional financial playbook may no longer function the same way. If you feel that the ground beneath the global economy looks less stable than headlines suggest, that intuition may simply reflect careful observation. Stay attentive to how these dynamics evolve in real time. The more clearly people understand the architecture of systemic risk, the better prepared they will be for whatever comes next. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.